the Borrow Smart segment. Today being brought to you by rsrmoney.com. rsrmoney.com. The debt consolidation refinance, how homeowners leverage their mortgage to achieve financial freedom. The debt consolidation refinance takes advantage of the fact that mortgage rates are typically lower than those of credit cards, personal loans, and even auto loans. By refinancing your mortgage to a larger amount than you currently owe, you can use the additional funds to pay off your higher interest debts. This consolidates your household debts into one monthly mortgage payment, simplifying your financial obligations. Generally, that payment is going to be lower than what your existing payment is. You use the extra money to pay down your mortgage more quickly. And as we talked in the earlier segment, cut that mortgage payment by a significant amount. Number one, we got to talk about the blended household interest rate. Before deciding on debt consolidation refinance, it's important to understand your blended household interest rate. This is the weighted average of the interest rates of all your outstanding debt, including your mortgage, credit cards, auto loans, student loans, and any other personal loan. By calculating this rate, you can see the true cost of your debt and assess whether refinancing will lower your overall interest payments. For example, if the blended rate of all your house debt is 12%, but you can refinance your mortgage at 6%, the savings over time can be significant. How to calculate the blended interest rate? Multiply each debt's balance by its corresponding interest rate. Add those figures together for a total. Divide by your total household debt to find your blended rate. Second, we always talk about safety, liquidity, and return. Safety, liquidity, and return. That's why you got to get our book, rsrlinks.com/YCLA. rsrlinks.com/YCLA. These three principles guide the decision-making process when using home equity to pay off debt. Safety. Protecting your home's equity is essential. By refinancing to consolidate debt, you're transferring unsecured debt, like credit cards, into secured debt, your mortgage. This can reduce your overall financial risk, but it's critical to ensure you have a solid repayment plan so you don't risk foreclosure. Liquidity. Consolidating debt into your mortgage improves liquidity by freeing up cash flow that would otherwise go toward high interest payments. This allows you to allocate resources towards savings, investments, or home improvements. Increased liquidity enhances your ability to handle unexpected expenses or invest in growth opportunities. Return on investment. Reducing interest payments is a direct boost to your financial return on investment. Every dollar saved on interest can be redirected into investments, retirement savings, or paying down your mortgage faster. In the long run, the savings from refinancing at a lower rate can compound, increasing your overall wealth. So what are the advantages of debt consolidation refinance? Number one, lower monthly payments. One of the most attractive benefits of consolidating your debt through a mortgage refinance is the lower potential for monthly payments. By rolling your higher interest debt into a single payment at a lower interest rate, you can significantly reduce your monthly financial obligations. This not only provides immediate relief, but also improves your ability to plan for the future financial goals. Number two, interest savings. Credit cards, auto loans, personal loans typically come with high interest rates, some exceeding 20%. Mortgage rates, however, are often much lower. By refinancing your mortgage and using the funds to pay off higher interest debts, you could save thousands in interest payments over the life of the loan. Even though you may extend the term of your mortgage, the interest savings can make a significant difference. And remember, by using some of that extra money to pay down the mortgage, it actually can reduce the term of your mortgage. Number three, improved cash flow. After refinancing, you'll have one streamlined mortgage payment. Since this payment is likely lower than the combined payments of all your individual debts, you'll free up cash flow. This additional liquidity can be used for other important financial goals, such as saving for retirement, building an emergency fund, or even investing in home improvements that have increased the property's value. The blended household interest rate is a key consideration. Understanding your blended household interest rate is critical when considering a debt consolidation refinance. If your weighted average interest rate across all debts is significantly higher than the interest rate you get on a refinance, the decision to consolidate becomes financially sound. This calculation ensures that you're making a decision that maximizes interest savings while considering how long you plan to stay in the home, and the closing costs of refinancing. For example, if you have $15,000 in credit card debt at 20%, a $20,000 auto loan, 7%, a $250,000 mortgage, 4%, your blended rate might be around 5 to 6%. Refinancing your mortgage at 4% to cover the credit card and auto loan would reduce your blended rate, resulting in significant savings over time. What are we doing there? We're using some of the money to buy down the rate. The role of home equity in debt consolidation, your home's equity, the difference between its current market value and the remaining mortgage balance, can be a valuable financial asset. By tapping into this equity through a debt consolidation refinance, you can access funds to pay off credit cards, car loans, or other high-interest debt. Number one, home equity loans versus HELOCs. In addition to a full mortgage refinance, you might also consider other options such as a home equity loan or a home equity line of credit. These allow you to borrow against the equity in your home while keeping your existing mortgage intact. A home equity loan provides a lump sum with a fixed interest rate, making it ideal for paying off a large amount of debt at once. A HELOC offers flexibility, acting like a credit line that you can draw from as needed, which can be helpful for all future expenses. Each option has its benefits, but it's essential to weigh them against your overall financial goals and the principle of safety, ensuring that your home equity remains protected. So the pitfalls to avoid when consolidating debt: not addressing the root cause of debt. While considering debt into your mortgage or using home equity can provide immediate relief, it's crucial to avoid falling back into bad spending habits. If overspending was the cause of the initial debt, consolidating may only serve as a temporary fix. Establishing a budget and focusing on paying down the debt you've consolidated is essential to long-term financial health. Number two, refinancing without a clear plan. Refinancing your home loan to consolidate debt should not be done hastily. It's important to calculate the true cost of financing, including closing costs, fees, and the interest you'll pay over time. Ensure that the savings from the lower interest rates outweigh these expenses and that you have a clear repayment plan. Remember, strategy beats rate always. Bottom line, for homeowners, a debt consolidation refinance can be a powerful tool for reducing high-interest debt and improving overall financial health. By refinancing your mortgage to pay off credit cards, auto loans, and other debts, you can lower your blended household interest rate, reduce monthly payments, and free up cash flow for other financial goals. However, it's crucial to approach this strategy with care, ensuring that the decision aligns with the principles of safety, liquidity, and return. Done right, debt consolidation can provide homeowners with a path to financial freedom while leveraging the equity in their homes to secure a brighter, debt-free future.